Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker right here in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Coming to you once again with some, if not interesting, frustrating news in the world of real estate that will likely affect all of you out there if you're planning on getting a loan after May 1st of 2023. This one is a bit of a mind blower. I'm hoping this one does not survive long. The timing is bad. The idea is bad. Well, the timing is bad anytime, but there are changes coming to FHFA. That's the Federal Housing Finance Agency. Policies on conforming loans for buyers. The short version is if you are more qualified, you are going to be penalized as a borrower. So let that sink in for a second. You're going to pay a higher interest rate and you're going to pay a fee if you're more qualified than other folks. This is a complete reversal of the idea that demonstrating financial responsibility, etc., makes you less of a risk, so therefore you pay less for your loan. And instead, to support folks who have proven the opposite, right? Who have a low credit score, who have proven through their financial activities over the course of their financial lives that they are less of a good risk. So it's a scenario of ignoring the reality of who is asking to be borrowing money. It is picking winners and losers. And the bottom line is the government shouldn't be in that business of picking winners and losers, no matter what we're talking about. But increasingly, that seems to be a role that they want to take on. But let's get into it. Let's talk about a few things, because I think that a lot of folks don't seem to get that this will affect you. And I want to make sure you understand first, what is this all about? So these are the FHFA. So think government-sponsored entities. This is Fannie and Freddie and all those guys. And you think, well, I'm not going to get my loan from Fannie or Freddie. Well, yeah, you kind of are. It's called a conforming loan. And a conforming loan, to just sort of set the stage here, is any loan that conforms to the rules set by FHFA so that loans can be purchased on the secondary market by Fannie and Freddie and all those wonderful things. It's so that banks can transfer the liability to the government-sponsored entities. And the way they do that is by conforming to specific rules and requirements that are set forth by FHFA. So as long as you check all the check boxes on that magical list that makes your loan conforming, you can underwrite this loan, you can fund this loan, then you can hand it off so that you no longer own any of the risk relating to that loan. That was one of the things that bit us last time. This is subsidized subprime lending, because that's exactly who this is aimed at, right? A subprime loan isn't a referral to the house. It isn't even a referral to the loan itself. It is a referral to the person who owns the loan, the person who undertook the loan, right? The borrower. It's a classification that they are subprime, meaning they are not a prime borrower. They have deficiencies in their credit, or they have demonstrated a past of not paying bills on time, or not paying bills at all, or whatever else has tainted their financial background. So let's get into this. Now, I'm going to go ahead and there are a few articles out there, surprisingly few, but there is one out there from the Washington Times that I've been holding on to. And boy, this is a week where we've got plenty of, I frequently will find subjects that make sense for a podcast. This, I had choices of two. The one that I'll be doing for next week is on queue already. But boy, when something this dumb comes up, to have two really dumb things come up at the same time was a mind blower. I'll try to build some of that podcast suspense to let you figure out what next week's stupid thing is for the show. But let's go ahead and jump in. So a new federal rule forcing more qualified home buyers to pay higher mortgage rates and fees to subsidize people with riskier credit ratings. So right off the bat, I don't think the philosophy underpinning that makes any sense. I would much rather see let's say we did agree that it was a very good goal to lend to subprime borrowers. Well, you don't just make the loan, right? Let's figure out what the philosophy is here. Is the philosophy, okay, they've proven they're not in a position financially to take on this burden of a loan, right? And we've seen that in the past. All of the feel-good programs that just say, well, you know what, let's give them the money anyway. They're not qualified, but let's give them the money. You're not really giving them the money. You are burdening them with hundreds of thousands of dollars of debt that they have demonstrated they cannot manage, right? That's what your credit rating is supposed to be telling people. So instead of this money going towards simply overlooking the deficiencies of their credit, if this was going towards education, if this was going towards making folks who really don't have the knowledge or experience to manage their financial business, to give them those skills, I'd be far more swayed, I guess, to buying this one. I probably still wouldn't be fully on board. But any program that just says, hey, you know what? We've got these rules that represent financial sense, and we've created these standards you have to meet in order to qualify for certain kinds of loans and to make a home purchase, those types of things. But you know what? The weird part of this sentence is the ending ends up being the opposite of what you would expect. But in your case, because of your financial background, we're going to overlook all the deficiencies in your background and go ahead and give you the money anyway. Where that sentence should read, because you've shown such financial responsibility, we're going to give you a preferential treatment on a loan because you're less of a risk. This is all about just who is or isn't a risk. That's it. I know everyone wants to sort of heap on it all these other things, and whatever you want to heap on it, fine. But the solution is not to say, all right, we're going to ignore your lack of qualifications and say, we are either going to reform public education so that everyone gets a good financial education, or before you can borrow this money, if your credit score indicates you're not ready, we're going to make you go and get educated so that you can manage these debts. You're not helping anyone. And some people misunderstand my point because I have seen what happens to people who get caught in a downturn. As long as the market's growing and everything's going up, everything seems to be fine for these folks. But as soon as something goes down, these folks drop first, fastest, and hardest. And it is unbelievably painful to see. It is clear they never should have had that level of financial burden to begin with because they are completely unprepared for it. And the system can very much trample over those folks. Whether everything from trying to get through a short sale, trying to negotiate through a foreclosure, every element of it is just soul sucking. And I hated watching people go through that after the last one. So maybe that's it. Maybe that is my, war story from the last financial apocalypse is that I don't ever want to see people go through that again. And policies like this will make people go through it again, because I'm not seeing anything that tells me that for the year or 2 years after this rule goes into place, that these folks are going to be in a marketplace that will do right by them. I do not think that folks who buy under these circumstances right now are prepared to potentially deal with being upside down on their house in a year or 2 years. And I think there's a good chance that in many markets, that is what is going to be happening. So let's go ahead and cover the long and short of it here. The fee changes will go into effect May 1st as part of the Federal Housing Finance Agency's push for affordable housing. They will affect mortgages originating at private banks across the country. All banks try to lend on a conforming loan. All banks want to lend money to you and conform to the requirements of FHFA so that they can sell the loan on the secondary market. They can hand it off to these government-sponsored entities. And remember, in addition to this screwing over more qualified borrowers, this also burdens the taxpayer with these potential downfalls, right? So you are encouraging proven underqualified borrowers to borrow more, and then you're passing the liability of those loans on to the government-sponsored entities, which your tax dollars pay for. That's what happened last time. Remember we had TARP and all that other kind of crazy stuff? That's what this is. This is bailouts for all of these institutions that needed it because the market took a huge dump. I actually saw a chart on Twitter that kind of blows me away. If you just take the chart at face value, it's like, wow, the bottom of the home pricing market is potentially way worse than a lot of people think. I want to take a closer look at it, but I check it out on Twitter. You can find me Rebel Broker at Twitter to see more on that. Okay. As I said, they will affect mortgages originating at private banks across the country. The federally backed home mortgage companies Fannie Mae and Freddie Mac will enact the loan level price adjustments, or LLPAs. Mortgage industry specialists say home buyers with credit scores of, and this is the one that just blew up. I mean, it's not even like they're subtly sneaking this in, right? It's not like they're creating some sort of convoluted thing where you don't really upfront realize it sounds good. It's like the more money for all the good people bill, right? The title sounds good. Everything sounds wonderful. But then when you actually but there's no hiding this. This is just right here. Mortgage industry specialists say home buyers with credit scores of 680 or higher will pay, for example, about $40 per month more on a home loan of $400,000. Home buyers who make down payments of 15% to 20% will get socked with the largest fees. What? And if you don't pay that amount, you have to do PMI. So, right? Or am I missing it? I just teamed up with a local lender, but I would reach out to all my listeners out there that are lenders. Set me straight on any of this I'm wrong on. But if I'm not mistaken, if you don't do that 20%, odds are you're paying PMI, right? So you can either pay the fee or you can pay PMI. Crazy. These fees only apply after May 1st, but they apply to both purchases and refinances. Quote, the changes do not make sense. Penalizing borrowers with larger down payments and credit scores will not go over well, according to Ian Wright, a senior loan officer at Bay Equity Home Loans in the San Francisco Bay Area. Yeah, absolutely. I don't understand where this is going. I don't understand why you penalize people who are doing it right. Do I believe that we should help folks who aren't qualified to borrow this money? Yes, but not by simply skirting the rules and saying, okay, well, we're not going to apply them to you. But as I said, to making sure they get educated, to give them the skills to not need you. And I think that's the problem. I think whenever we talk about a problem like this, no matter what it is, the goal should be to give the individual the skills and powers they need to not need you. And that is something that I think doesn't go for people. I think in order for some people to feel important or to feel like they're doing the right thing, people need to be dependent on them. And you need to empower people to be independent of you. And this does not obviously do that. Let's see. This quote, this confusing approach won't work, and more importantly, couldn't come at a worse time for an industry struggling to get back on its feet after these past 12 months. Mr. Stevens wrote in a recent social media post, to do this at the onset of the spring market is almost offensive to the market, consumers, and lenders. So let's think about this for a second. Now, as a borrower, do you have other alternatives? Well, if we're looking, and again, all my lenders out there, I want to hear from you. If you want to pitch a loan, a non-conforming loan, because that's what we're really talking about here, right? If you want to avoid this, if you think this is horrible and you do not want to participate, in order for you to do that, you've got to go non-conforming, because that's what a conforming loan is. For those who don't know, that is the definition of a conforming loan. So that means you have to go non-conforming. So how do you do that? Well, first, I would strongly suggest you go, there's a variety of different options, but you would want to first start with banks or lending institutions, direct lenders that don't sell their loans in the secondary market, which are by definition non-conforming loans. To get the biggest selection of those, find yourself a good local loan broker who keeps tabs on a bunch of different loan products that you might be able to draw to. And I'm imagining that probably some credit unions are non-conforming. Again, that this is me suggesting a place you can check. I haven't checked. But if this bothers you enough that you don't want to support this kind of policymaking as it relates to financial institutions and lending, that's really your option, is to go non-conforming. And you can absolutely look at it, but you're still going to want to do the math. And you may discover that once everything is said and done, you're paying more, even with the fees, than you would have if you had simply gone with the conforming loan. So just arming you with knowledge, make the decision that makes sense for you. I know for my next loan, I'm going to probably look for, I don't want to participate in a system I think is screwed up. But again, the reality is what the math is at the end of the day. What effect would this have on demand? Well, I'm guessing not many buyers are going to step away from the market entirely because of this, but it is going to enable a bigger pool of subprime borrowers to get into the market. So what does that sound like? The last time that we pushed more subprime borrowers into the market as buyers was when? Well, I would, 2000 up to 2007, right? So we are going to increase demand on homes with subprime borrowers, which will have two effects. One, given the amount of months of inventory we have right here in Silicon Valley, if we see a big uptick in buyers here, we would instantly be in a seller's market, right? For those of you who haven't checked out my most recent video on the real estate markets here, I did one during the April Coffee and Real Estate, where I covered Santa Clara County and sort of did the big numbers for San Jose, Morgan Hill, and Gilroy. I'll put a link to it right up here for you to check out. We have less than 2 months of inventory everywhere, right? Well, and a balanced market is 5 to 7 months. So just based on months of inventory, if we suddenly see an uptick in demand, we suddenly get multiple offers back and we suddenly see house prices go up. So it raises prices because it raises demand. It artificially increases demand. That's what happened last time. Free money started flowing and it increased demand, which just caused prices to go crazy. So that's one concern that I have. Next, it obviously penalizes the most qualified borrowers, but it may interestingly drive a more innovative lending scenario. If enough people are just upset about this, we might see some growth in non-conforming loans, in alternatives in the non-conforming loan world. So that'd be kind of interesting to see. In the wake of a 3 percentage point increase in mortgage rates, now is not the time to raise fees on home buyers, Kenny Parcell, president of the National Association of Realtors, said. And for once, I agree with someone from the National Association of Realtors. Yay, association. I think this is absolutely true. Under the new mortgage financing rules, home buyers with riskier credit ratings and lower down payments will qualify for better mortgage rates and discounted fees. The fee changes are intended to subsidize higher risk borrowers. It's not hidden. It is specifically designed to elevate high risk borrowers. That's what happened last time. How we don't learn from these things, I don't know. And how we believe that simply overlooking what we have for decades rightfully assumed are good measures of credit worthiness shouldn't apply just boggles my mind. And the idea that this won't increase as a percentage, if you take the overall number of loans that are put out, it will increase the number of defaults at some point, simply because you are lending to subprime borrowers. And by increasing the percentage of borrowers who are subprime, you increase the risk level to the overall system, particularly when the system comes under stress. And I believe in the next year and a half to 2 years, this system's going to come under stress. And I don't think that's going to be a good thing. And I would love to think that the government's learned its lesson and will not bail banks out if a bank fails because it did this. Now, see, last time, I think a lot of these bailouts happened because behind the doors, the banks were like, hey, listen, we did what you told us to do. In 1995, you beat us over the head with a stick because we weren't lending enough to certain underprivileged groups. So you said we had to do that in order to get new branches or to expand or do any of these kinds of things. So we did it. Well, and then all of a sudden from 1995 on and then right in 97, 98, 99, things started to go nuts. And that's what led up to the 2007 downturn, right? The Community Reinvestment Act was one. That's from the 70s. But didn't have teeth till 95. That's a whole other podcast from years and years and years ago. But the bottom line is the reason that crazy growth happened was because it facilitated all of this crazy lending. And it wasn't because the banks were being stupid. It was because the banks were doing what they were asked to do to qualify as conforming loans. So what do you do in that scenario? You do what you're told. So I think that there was a conversation that was had and banks had to get bailed out. But interestingly enough, not all banks got bailed out. If you had a very cozy relationship with certain members of Congress, apparently your bank got bailed out first or got bailed out at all. But anyway, we can have that conversation over an adult beverage at some point down the road. The reality, though, is we are mimicking the things that screwed us over last time when we faced a downturn. let's see, was there, okay, so there was nothing really else that I thought jumped out at me here. But just sort of wrap your head around this and what could the effects of this change be? I think one positive effect, as I mentioned, is the possibility of seeing a growth in non-conforming loans. I would love to see that happen. But the more likely reality, and I don't think there's a lot of theorizing that needs to be done there, it will increase the number of buyers. And that is an artificial increase that, given the nature of the folks who will be in that group of increased buyers, represents a problem in terms of what it's going to do to prices, what it's going to do to demand, and what it's going to do to the resiliency of those loans months and years after they're originated. So something to keep in your back pocket. It is the 24th as I record this. You've got just a few days to close on your loan or to get your loan done so you avoid these fees. But on May 1st, this all starts, and it is really, really dumb. So the goal here is always to leave you with more knowledge on the table than I take up in your time. Absolutely, I hope we've achieved that today. Sorry for the nature of the knowledge. I guess bad news is news, whichever way you want to look at it. So it's worth having in your pocket. I really appreciate you taking the time to listen to what I have to say on these subjects. If you'd like to find more ways to reach out to me, you can go to soldbyrobert.com, where you can find this podcast. You can find a link to Coffee and Real Estate. You can find the other articles that I post on a monthly basis. You can also find my YouTube market videos, links to those on my website as well. You can also find me on YouTube, obviously, but links are all there at the top of the page as well. And you can also mail me directly or use my buyer and seller tools that I make available to everyone. And as I mentioned last time, I have some amazing brand spanking new buyer and seller tools available to you. The buyer stuff is still kind of in the works in terms of integration, but the seller tools are freaking amazing. So make sure to check those out at soldbyrobert.com. You can get involved there just by going to the front page, top left side, get a value of your home, and you'll automatically start seeing what you need to see relating to not just the value of your home, but all kinds of amazing information that you are going to be stunned at when you finally get your hands on it, because it's amazing. It's the best seller tool or homeowner tool. I wouldn't even call it a seller tool, even if you don't want to sell. It is a fantastic homeowner tool to get a handle on all things relating to you, what you owe, and what your options are. So I hope you guys make use of that. All right, folks, thanks again for listening, and I will talk to you all next time.